We have some breaking news. Moody's, which is one of the top 3 largest financial rating institutions in America, has officially downgraded the United States banking system to negative. This is a crazy milestone in our history. The fact that we've been downgraded to negative is actually quite frightening. There's a couple things that you need to know, and there's a couple things that you can do right now to make sure that you're protected, you're preserved in case we see another potential global financial crisis like we saw in 2008 with the banks that failed. Before we jump into that, it's important for you to know how banks work. Banks operate on what's called a fractional reserve banking system. The way that this works is for every 10 cents that they have in the vault or in deposits, they're allowed to lend or lever $1.40. So 14 times or 140% over the cash or deposits that they have on hand. Well, this can be very dangerous in the event that the 10 cents or the 10% in deposits goes out the door because then they're out of balance, or if the loans, the 140%, happens to default because of bad loans or it's a tough economy and people can't pay their obligations. What we saw with Silicon Valley Bank a week ago was Silicon Valley Bank had brought in about $180 billion in deposits. Deposits are very expensive to service because you have to have branches, tellers, infrastructure. You have to have high overhead to service the deposits. So the way that banks do that is they have loans, and that's where their profit comes in to cover the cost of servicing the deposits. Well, what ended up happening with SVB Bank is they had so many deposits come in, they did not create enough loans to cover the cost of servicing the deposits. So what they did is they took some of that money that would otherwise be used for loans and they put it in treasury bonds, long-term treasury bonds, and it was only making like 1.9%. Well, now you fast forward to today, the interest rates are a lot higher. They're like, hey, we're actually losing money. Let's sell it. We'll take a loss. It was about a $1.9 billion loss. And some of their depositors realized that, hey, SVB Bank took a loss. Now they're asking for help. Let's get our money out. And that is what led to the bank run, which ultimately led to the bank's demise. Now, if you're gonna keep money in banks, this is really important, okay? The reason why a lot of people are very concerned right now is you're starting to see top 10 banks like Credit Suisse on the verge of total collapse. And like Lehman Brothers back during the global financial crisis, all it takes is one big one to potentially take all of them down. So what does this mean for you and what can you do practically? Well, what it means is that if you have more than $250,000, you should spread out your money. I like regional banks, and I'll tell you why. See, what we don't want to have happen here in America is we don't want to have big central banks. If we centralize our banking system here in America, that's really bad for capitalism and for freedom, because then they can choose who they do business with. The fact that we have small and regional banks across the nation allows small and medium enterprises to get up and going and get the funding that they need to start. If you wipe out small and medium banks, you wipe out small and medium enterprise. And if the total centralized banks came down to 5 big ones, that's where freedom literally leaves America. In fact, the guy who started quantitative easing, who came up with it, studied Japan. And when Japan had pinnacled, had reached its peak of prosperity growth, it was the standard for growth in any nation. The bubble burst for them and they started to go down and they had 3 decades of stagnation. It came from the fact that they centralized their banks and they got rid of the regional banks. And henceforth, all of the innovation and the enterprise left Japan and went to other countries. Japan is a very fascinating case study. Now, there's some other things that you need to know. So we got banks versus insurance companies. Did you know that the top 5 banks, they invest their profits not in the stock market, not primarily in real estate. They invest their profits from the banks in insurance companies. And here's why. Did you know that insurance companies have a minimum solvency standard? And what that means is for every dollar in liabilities, they are required to keep 110% of that, maybe even 115, sometimes 120% in cash or cash cash equivalents. What that means for you is that if this institution, this insurance institution, were to pay out all of its liabilities, all of its shareholders, everybody that has a vested interest or has a policy or has some sort of investment, if they pay out everybody tomorrow, they've got billions of dollars in cash left over, which is why they are the last domino to fall in an Armageddon scenario. In fact, not one A-rated insurance company, not on property and casualty, that's different, not one A-rated life or annuity company has actually failed since 1900. Now check this out. Hybrid CDs. This is an alternative if you don't want to keep a bunch of your money in the banks. You are able to get a greater rate of return than the banks are offering. There is liquidity provisions, and you can earn about 5.5% as of the filming of this video. What this is going to allow you to do is put your money in something safe, get a very decent rate of return, have liquidity options, and frankly, have peace of mind. That's what it's all about in retirement or as you're getting close. So if you're going to keep your money in the banks, what you want to do is you want to spread it out. I like regional banks. We need to keep the regional banks strong. And by the way, regional banks typically are safer and more astutely and frugally run in their investment vehicles and their investment initiatives than the big banks, because the big banks are too big to fail. They know that, and because the government just gave them an unlimited check where, hey, if anything fails, we'll bail you out. Well, now these big banks are going to be taking big risks. And if it works out, great. Everybody gets a bonus. We get to keep the profit. If it doesn't work out and we fail, we'll socialize the risk. We'll let the government pick up the tab, which is you and I, the taxpayer. So we need to keep regional banks. We need to keep our money spread out among regional banks, because if these big banks can consolidate the little ones and centralize, America as we know it has lost its freedom. So keep your money spread out during this time. Don't keep any more than $250,000 per person, per bank, and consider hybrid CDs. It's the last domino to fall in an Armageddon scenario. It's crazy what's going on in our economy right now. Please make sure you like and subscribe. We're going to keep you up to date with what's going on and give you practical tips to make sure you're safe and you're succeeding. We'll see you on the next video.